Good morning, hello and welcome to Opening Bell. You're with us on Moneycontrol and I'm Surabhi Upadhyay. It's Friday morning and a lot of participants in the market will say, thank God it's Friday, considering the kind of Thursday that we had yesterday. A complete slam dunk in the market ending at the lows of the session and breaking a lot of important technical support levels in the process. Well, we've woken up to cues which are fairly cautious. There's a lot of geopolitical talk, rhetoric up in the air. US is saying that striking Iran is still on the table. And of course, we have the continued concern around US IT services. We've seen some of the big stocks sell off again overnight. So there is plenty to track. The risk off is showing up in oil prices. They have been rising. So lots going on. The question is whether the Indian market kind of preempted this global tension and therefore whether we fell yesterday itself. So will it be a range bound day today or is there more downside opening up? That's what we'll talk about with our experts as we go along. Let's start with the headlines. Rising US-Iran tensions rattle Wall Street, dragging all three major indices lower as investors pare exposure to financial stocks. Attention now turns to key economic cues with US personal consumption expenditure data and Q4 GDP figures in focus. Asian markets mirror weak global cues, though South Korea's Kospi bucks the trend and Hong Kong resumes trading after the Lunar New Year break. Crude oil prices hover near 6-month highs and are on track for a strong weekly gain as uncertainty mounts over a potential US strike on Iran. Meanwhile, gold extends its rally as investors weigh a cautious Federal Reserve outlook alongside resilient US economic data and escalating geopolitical tensions. The Wall Street reeled under intense selling pressure yesterday with the Nifty dropping below all key moving averages and over 7 lakh crore rupees got wiped out from investor wealth. Early signals remain weak. The GIFT Nifty is pointing to a subdued start for Indian equities. Moneycontrol Newsbreak confirmed Swiss pharma giant Novartis AG has signed an agreement with private equity major Chris Capital to sell its near 71% stake in Novartis India. Following the share purchase pact, the acquirers will launch a mandatory open offer for public shareholders at a little over 860 rupees per share, in line with SEBI regulations. The deal marks a change in control for the listed Indian arm. Okay, so we don't have very much positive cues to report this Friday morning. That's the sum and substance of it. So let's go over what really happened. We had a negative close on Wall Street. Markets were down between 0.3% to 0.5% depending on which index you're looking at. But all the three major indices, the Dow, S&P 500, the Nasdaq, all were lower. Yesterday, the private equity space in the US was very interesting. There is a private equity firm, Blue Owl, and that seems to be running into a little bit of a liquidity issue. It has frozen redemptions, investor redemptions in one of its funds, and it is also it will be selling over $1 billion in assets to raise capital to pay back its investors, and that really rattled nerves. It got people back, thinking about those eerie times of 2008, or what's happening? Is there a credit problem building up, etc. So private equity names like KKR, etc., were also under pressure in the US market action yesterday. In addition, of course, US tech continues to be a space where there's a fair amount of uncertainty. So some of the larger stocks like EPAM, for instance, it was down 17%, came out with numbers and the guidance sounded pretty weak. But the bigger headlines were coming in from the geopolitical space because President Trump has now said that there is a possibility of the US striking Iran over the next 10 days. He says maybe we will, maybe we won't. You'll get to know over the next 10 days. And I'm now quoting him exactly. He says, and I quote, "It's proven to be over the years not easy to make a meaningful deal with Iran. We have to make a meaningful deal, otherwise bad things will happen." So what are those bad things? Well, the market obviously is pretty nervous about them. Brent rallied big time. Brent oil prices are above $71 a barrel. The rally was almost 2% overnight. In fact, it's closer to 72 rather than 71. So that's obviously quite negative for the Indian market. The dollar was rising on the geopolitical concerns. That's one part of it. And then there was strong jobless claims data. Jobless claims did not rise as much as expected in the US market action. In fact, they fell. They were down 23,000. The number came in closer to 2,06,000. And that was lower than estimates, giving people some optimism about the health of the US economy. Now, most of the Asian markets are trading soft. The Nikkei is down well over 1%. The South Korean market has been bucking the trend. Kospi is still up about 1.3% last I checked, but otherwise all of the other Asian markets are negative. Hong Kong is also down as it comes back from that Lunar New Year holiday. Now let's talk about our market action. The Nifty wiped out 3 days of gains, previous 3 days of gains in one swipe in yesterday's fall. All of the sectors were negative, mid caps were down, so it wasn't like a Nifty specific problem. In the entire market was actually lower. The VIX surged big time. The VIX was up over 10% yesterday. Now the Nifty has fallen a lot of key moving averages, the 20-day, the 50-day, the 100-day exponential moving average. And the other thing is that FIIs turned sellers in the action again yesterday in terms of the cash market action. They sold off cash stocks worth almost 880 crore rupees. Domestic institutions, by the way, were also on the sell side. They sold off stock worth almost 600 crore rupees. So the flows were negative. That kind of just compounded the fall. The question is whether the worst of it got done yesterday or whether, now that we've woken up to these negative global cues, whether there will be another leg down today. Let's take that up with our experts. We have Raja Venkatraman, co-founder at NeoTrader, joining in. Raja, great to have you on the show. So that's really the question. Just tell us about the market's technical setup in yesterday's one-way decline. Mayuresh is also joined in. Great, Mayuresh. Happy Friday to you. I don't know how happy it'll be, but anyway, it's at least Friday. So, Raja, you go first. Talk about the technicals. I mean, how bad was yesterday's fall?
Yeah, good morning and thank you for inviting me to the show. So, when you take a look at the overall trends over the last few months, you will see that the trend does not seem to be lasting very long. It can be geopolitical news flow or it can be domestic news flow. What we are seeing right now is that again the geopolitical news flow has come into play and the prices have now dipped down into some important supports out here. So once again, we are back to square one, and I would say that 25,400 to 25,500 on the Nifty spot assumes a lot of importance going ahead into the coming week. We are also going to end the monthly expiry as well. So next week is going to be with volatility. So I would say that at the current juncture, the market is poised for a rebound because the important supports are going to be tested, and also it's Friday today, so I don't think that short positions would be carried forward, considering the uncertainty that is being quite visible right now. So I would say that the market is uncertain, and with the kind of fall which we had seen yesterday, probably today could be a range-bound day, and a closing below 25,400 would invite more downside. Otherwise, I would say that the most of the day today could be spent in a range-bound session. Higher levels once again could come into a shorting scenario where I would say the resistances are emerging around 25,600. So I would say that we need a closing about 25,600 to once again resume the upward journey. Otherwise, it's going to be a tough ask for the market. So yes, there will be stock specific action. So that we need to see how the day unfolds, because right now, also from the Asian markets, we are not having any kind of support. So it's going to be a tough day out there today.
Yeah, absolutely. I mean, there's not much positivity. Maresh, morning. I mean, not the kind of Friday you want to wake up to, but it is what it is. I want to talk about this rise in oil prices, Maresh. Do you think this can be an added fresh negative trigger, or is it going to be more kind of restricted to individual stocks? And we saw that play out. Yesterday, oil marketing companies were lower. Some of the names like Oil India and ONGC, the upstream guys, fared better. So this rise of Brent oil back to 72, is it just a stock specific issue, or could it become one more excuse for people to sell?
Morning, Surabhi. Always a pleasure to be on your show. No, I think two things. One, I think escalating oil prices is more resultant factor based on what is happening on the global news, and Trump probably threatening Iran as we speak. And therefore, I think the sentimental impact does get felt by all consumers of either crude or crude derivatives. So you've obviously got OMCs, you've obviously got aviation companies, you've got paint stocks, you've got tire companies, which probably will get sentimentally affected. However, I think if something on the global macro or the global political front has to play out, and crude moves even further as we speak, then probably it becomes a structural issue. But till that point of time, I think the inventory levels for most companies within the sectors are taken care of. So unless it is a elongated issue, I don't foresee that earnings might get hit for all these companies who get affected by crude and crude derivatives as an input. Structurally, I think if something goes wrong over a longer period of time, that is when the hit will start coming.
Raja, your thoughts on the same set of stocks, and then we'll talk about today's stocks and news. But let's just get the crude trade out of the way. HPCL, BPCL, IOC, what would the advice be there? And on a name like ONGC, which rallied almost 4% yesterday, is there a long trade? Any oil-related trades basically this Friday, Raja?
Yeah. So yes, the oil-related news flows are continuing to attract attention, and at a 6-month high, definitely all the oil stocks would come into play. 2 weeks ago, we had also discussed about ONGC, and I feel that ONGC is coming out of its shadows, and I feel that amongst all the oil companies, ONGC setup looks quite encouraging. And with the kind of news flows that are emerging, I think that the trend in ONGC can continue to sustain. So, if one wants to trade into ONGC, then into oil marketing companies or oil related companies, ONGC would be a preferred bet.
Okay. All right, gentlemen, just stay with us. Let's quickly run through some of the interesting stocks that are in news today, news flow, focus, deals, etc. And then I'll come back and we'll keep getting your thoughts. So starting off with our stock list for the day. ABB India reported numbers for the fourth quarter. The profit came in line with estimates. The revenue was slightly above estimates. The revenue was up almost 5.6%, came in close to 3,557 crore rupees. That was a beat. The profit was lower as largely anticipated. Profit was down about 18%. The EBITDA was also lower by about 17%. And there was some margin compression, at least year on year. The margin has compressed to about 15.3%. The profit and margins declined because of cost pressures amidst one thing, one of the issues. The other good aspect was orders, because order flow surged 52%. That's the highest Q4 order intake in the last 5 years for the company. So that's ABB for you. Let's move on, and this is a Moneycontrol exclusive story that's finally been confirmed. Novartis AG, the global parent, is going to be selling almost 71% stake in Novartis India to Chris Capital and a bunch of Chris Capital related entities. So Waverise Investments, Chris Capital Fund X, and two Infinity Partners. Chris Capital will also be launching an open offer, as it is mandatory as per Indian regulations. And the price of that open offer is 860 rupees per share, roughly around that mark. And let's talk about CIE Automotive. The profit was down here 10.4%. Revenue was up about 13.4%. The EBITDA managed to rise as well for CIE Automotive, 11.7%. Margins came in around the 14% handle. Karur Vysya Bank would be in focus. It has trimmed its 1-year MCLR rate to 9.1% from 9.2%. So small change coming through, and the revision is effective the 22nd of February. Speaking of banks, watch out for Federal Bank as well. It's received an order from the Income Tax Department for a refund of 686 crore rupees. The order gives effect to an ITAT ruling which came in August of 2024. So that's going to be a bit of a hit for this particular bank. Moving on then, Waaree Energies is in focus. It's in talk with the Andhra government and other states as well to set up a greenfield manufacturing facility. This will be a battery manufacturing unit and the investment involved could be over 8,000 crore rupees. So keep Waaree on the radar. Texmaco has signed a JV with RVNL. They are looking to build India's next-gen rolling stock powerhouse, quote-unquote. So they're looking at a major collaboration on the wagon manufacturing side, and they're looking at large-scale infrastructure projects as well. So those are some of the stocks in news. Mayuresh, I just want to go back on some of the names that have been in focus. On the banking side, I mean, this news aside, the Federal Bank news on the income tax refund aside, what have you made of the earnings performance for Federal and some of the Tier 2 names? And what would the advice be on Tier 2 banks?
So, Surabhi, I think decent performance by tier two banks, whether you're talking about private or public, both. And I think the expectation in terms of core parameters like the NII growth was pretty decent. The outlook was pretty well laid out. Asset quality pressures largely have not accentuated on the balance sheets. In fact, on a quarter-on-quarter basis for a few of the banks, it has marginally come down as well. The NIM compression largely seems to be behind us as we speak, and so is the CASA deterioration. Capital adequacy looks well placed, specifically tier one ratios, and therefore sum of parts. If you probably look at all these parameters put together, I think the mid-tier names, both on the private and the public side, have given a very decent show. To name a few, I think Karur Vysya, you just mentioned, had a very decent show in our opinion. Federal Bank within the private banks had a decent show in our opinion as well. And within the mid-cap PSU banks, I think large part of that universe actually performed very, very well, whether it's a Union Bank or a Bank of Maharashtra, which came out with stellar set of numbers.
Okay. Do you have coverage on ABB, Mayuresh? I don't know if you
No,
managed
not a
to go
direct
through the
coverage.
numbers. What's the sense on the stock?
No, decent. And again, I think two themes where we've just released our reports. One obviously is the hottest theme that is coming into focus, the data center theme, and one is the power equipment manufacturing theme. So both these themes have a large scope in terms of not just the market opportunities that might come their way, the government capex that is probably expected to happen. So 9 lakh crores as an example in terms of transmission capex, expectations of data centers actually expanding to 6 gigawatt hours as we head into FY28, FY29. And therefore, I think with the incentives that are offered by the government, including the 8,000 crore incentive for the semiconductor PLI scheme that is announced, a large part of the pool in terms of existing large leadership stocks should continue doing well. So I think two, three stocks which are obviously on the radar. Cuban's India is something that stays on our radar. Hitachi Energy is something that stays on our radar as well. And therefore, I think these themes can structurally play out in the market. Obviously, I think the initial move in terms of price action Survey has already happened for a large part of this universe. But our opinion is that with all these elements acting as macro and micro enablers, these themes and a few key leadership stocks within these spaces over a longer period of time should continue.
Okay. All right, got that. Let me go back to Raja as well and talk about some of the trades. Raja, so we discussed overall Nifty and you said it's probably going to be more of a range-bound day. What about bank stocks and the bank Nifty? Is there a trade there? And how is the overall setup looking like for the bank Nifty?
Yeah, when you talk about Bank Nifty, yes, Bank Nifty has been performing better as far as the indices are concerned. And one of the reasons why Bank Nifty has been able to sustain is some stock specific results have come out well, and especially SBI cannot be ignored. And with the strong performance shown by SBI, it has managed to hold on the Bank Nifty quite well. Now, like Mayuresh just pointed out, the mid-tier banks in have been performing quite well. The Union Bank, or be it Union Bank, be it Bank of India. So these are some of the stocks, Indian Bank as well. So these are some of the stocks that have been performing quite well. So I would say that if you want to focus, even the private mid-tier banks have been performing, the likes of RBL Bank, Bandhan Bank. So I would say that if you want to focus, then the mid-tier stocks are the ones where we need to focus on. So these are some stocks that will be in action. Even AU Bank is having a good setup, and I would say that if the markets were to revive, then we will again see some traction emerging in these names. And I would say that the momentum has just begun. So in these names, so I would say that we could expect continued buying interest even on these current declines.
By the way, we have a viewer asking us a question. Harshraj Singh, who's writing in. By the way, viewers, you can actually send us your questions right now. This is the time, the next 5-6 minutes. We'll ask our experts to take your questions. So Harshraj Singh is asking, when can we expect the Nifty to break the 25,800 resistance? And then he's saying, can you give us some sectors and stocks that we can hold for the long term? So let me take the Nifty question with Raja, and then I'll come to Mayuresh for the compounding ideas. I think that's what he's asking for, that forget this intraday market. It's too difficult. give me some long-term wealth ideas. But let's talk about the short-term first. Raja, just revisit the levels on the Nifty. So on the downside, what is the Lakshman Rekha or the line in sand below which more short trades open up? And on the upside, his question is the same as I think most in the market. This 25,800 zone to 26,000, it's just become so formidable. The market just couldn't go above that.
Yeah. So what all of us are expecting right now is some encouraging trigger that can help us to sustain the up move. Right. Before yesterday, all of us thought that yes, probably we are going to end the week on a positive note, but that really did not happen. So we are really caught in a whirlwind of geopolitical tension. So considering this, I would say that I would wait for an end of day closing below 25,300 to actually consider that yes, we could experience more decline or end of day closing about 25,800. So now considering the kind of clause which Trump has given to Iran, so a 10-day window, which is as per the news flow, but we would say that at least for the next 10 days, I would say that the market is going to experience some volatility. So probably till the end of this month, I think that we would have some semblance of clearance of this particular threshold, and after that we would experience a new high. So that's what is my expectation. So let's see how the market unfolds and how the markets pan out.
Raja, there's one more question that another viewer is asking. Paddy is saying,
Sure.
Hi Paddy, morning. He's saying, can we sell Bajaj Auto at this price to book profits? Given how volatile the market is and things are very, very nervous, I mean, this is a very genuine question. If you're sitting on profits, specifically on Bajaj, is it time to get out?
Yeah, if you are sitting on profits, then like I said, that wait for the end of the day, and if the markets were to give up, then you could consider booking profits. If you want to be a little aggressive, then you can wait for the first 30 minutes of the day, and if Nifty is breaking the 30-minute range on the downside, then it's a signal of some more pressure. So you could look to book your profits.
Okay, all right, got that. So today's best trades, Raja, what would they be? One or two trades?
Yeah, I would like to go with a short in Tech Mahindra, considering the IT route that is having. I would say that the IT pressure continues to build, and I would say that one can continue to short Techem at the current levels, and one can also look to buy into a AU bank, because I feel that the mid-tier private banks are doing quite well, and if the markets were to rebound, then I would say that AU bank could be one of the strong candidates for an upside.
Okay, all right, Raja, thanks very much for joining in with all of that trading advice. You have a good day, good Friday, and a good weekend as well. Mayuresh, let's talk about IT actually. I'm looking at the weekly tally. Infosys is actually flat for the week because a lot of the fall actually happened last week, right? That's when the carnage was playing out. I'm checking TCS as well. TCS is down about 0.5% for the week. Of course, for the month, these stocks are down 14-15%. The question is, what now? Would you be a buyer at all, or would you, still kind of wait for more clarity to emerge on large cap IT?
We'll still wait, Surabhi. I think there are two reasons for this. One, I think with the disruptions that AI has created and the new launches globally, what has really transpired is that the entire business model is something that a lot of analysts are reviewing, as well as the management of all the IT companies as well. TCS 6% in terms of AI contribution, Infosys 5.5%, HCL take close to that 5.5% mark as well. Having said that, I think whatever mode they adopt, both organic and inorganic, I think they'll have to do that pretty fast over the next few quarters. At the same time, I think the expectations in terms of their existing client book, how the pricing will play out, how margins will play out, is something that the street will ideally like to watch out for. And if any accelerated capital or capex investments do happen, what happens with buybacks or dividends that these companies have been meeting out over the last few years? So does that lead to some element of stagnation in terms of forward P ratings? and re-ratings thereof is something to be watched out for. And therefore, I think from a price damage perspective, structurally, I think a large part of the price damage is done. But do you go out there and ambitiously and aggressively buy at this juncture? I think you'll ideally like to watch out for how numbers play out specifically for this quarter, what is the competitive landscape, and what is actually transpiring within this entire AI universe as we speak. So it might actually go through a time and a price correction both in terms of consolidation. So I think we'll wait and watch at least for the next few weeks in terms of all these developments that are taking place.
Okay. By the way, the pre-open rates are here, and the market is now trying to find its feet, and it's quiet. So we've got about a 30-point drop on the Nifty as of now. That's what's showing up. Eternal is weak, down about 2.5%. Bharti Airtel is down about 1.5%. Bajaj Finance, HDFC Bank, these are some of the names on the financial side. Let's get to the stocks. We've been on the Nifty. Now let's talk about the stocks. So here are the losers. Eternal has had a very rough week, and our next guest is going to focus on these platform companies. In just a bit, we'll have Karan Taurani joining in. Eternal is down 2% today. It's lost about 7% for this week as well. ITC, Axis Bank, those are the other names. You're still finding a smattering of IT on the red side of the screen. So still seeing some of these names like Infosys. Infosys is down 1.4% this morning. So watch for this. Infosys has very quickly become the biggest loser in the pre-open session. So let's see how this plays out. And then there are some of the banking names like ICICI Bank, Axis Bank, all slightly soft. On the upside of the Nifty screen in the pre-open session, it's all commodities. That's where the action is. Hard commodities. Tata Steel, ONGC, JSW Steel. These are the stocks that are bucking the trend in otherwise what seems to be a bit of a challenging Friday morning. So watch for this. Reliance is a good support. Reliance is up about 0.7% right now in the pre-open session. That's how things have played up. ABB is reacting negatively after its numbers. Stock is down about 2% at this point in time. So we'll keep flashing more names from the mid-cap list as well. But right now, Nifty is down about 50 odd points in the current juncture. So let's talk about something more positive and brighter, Mayuresh. This whole week was about AI and the AI summit and those who are forging partnerships. Names like NetWeb rallied through the roof. Wherever there's a little bit of a hint of, some AI trend or AI trade. Do you have any AI stocks in mind or any so-called data center stocks in mind? We don't have any pure play. I mean, there's Fractal. Fractal is a recent listing. But let's talk about the positive. Let's talk about new age, new technology. So what stocks to invest in?
No, so I think, as I said, I think both these themes and Cummins India is something which is a proxy to both data centers and power equipment as a theme. Cummins has a 40% revenue share coming in from data centers as well as critical power equipment as well. And both these themes should work in favor of this company going forward as well. As I said, the expectations of having 6 gigawatt hours by 28 is a reality. The tax holidays obviously aid growth. And power equipment as a business where there are huge opportunities happening in terms of hydro, small hydro, nuclear, semiconductor, EPC players, transmission lines. I think that is where I think the crux of the matter would be. And therefore, I think one of our top ideas might be Cummins India. One more stock that we'll keep on our radar is Neyveli Lignite. Our take is that not just the core power generating business from thermal, but renewables will also take a large share. In terms of the rare earth theme that has also got mentioned in the budget and the corridors expected to come through, they've done a huge investment of almost 15,000 odd crore in terms of a huge deposit in Northeast, which should incrementally start contributing in terms of their overall numbers as extraction starts happening over the next few quarters. And the management probably believes that they can probably hit that 45% EBITDA mark by FY 27-28 and 50% by FY 30. So I think a couple of stocks in focus on that front. To cheer something up, Surabhi, I think I was at a conference a couple of days back, and a lot of mid-sized companies had come to that conference across sectors, and a lot of managements that we met were extremely upbeat in terms of not just the order books, but in terms of how the positioning is probably happening in terms of the economy from a macro perspective. And therefore, across sectors, a large part of this mid-cap pool that we met seemed very, very optimistic about the second half. And therefore, our opinion is that second half should be very, very positive for the Indian.
So, Mayuresh, leave us. See, that sounds nice. Now it feels like a Friday. Optimism, right? So, leave us with some. You named a couple of names. You named you named Cummins. So, leave us with that compounding idea. That's what our viewers were asking, right? That forget the near term. Just give us some, medium term wealth creation ideas. So, Cummins would be one. What else?
So keep a watch for Neyveli Lignite. Our take is that this company is poised for reasonable and robust earnings growth, both in terms of top line, in terms of margin expansion, as I just mentioned, and correspondingly bottom line growth with strong free cash flows. And therefore, I think Neyveli Lignite might be one idea which might probably play out over the next few years very, very positively, assuming all these themes expected to play out. You can't leave the financials behind, Surabhi, and therefore I think among the larger banks, obviously ICICI Bank is something to be kept on the radar. IDFC first. The bank is consolidating as we speak, but our expectations is that both the retail component and expectations in terms of how the book is expected to play out, along with the valuations as a risk reward and the rating rankings that we probably see, seems to be a good plausible idea. So I think financials, manufacturing, capital goods, power, I think these seem to be the themes and a few ideas within that.
Okay. All right, Mayuresh, thank you very much for joining us and giving us some inspiration and some ideas as well in an otherwise lackluster Friday morning. Thanks for being with us. Have a great day. Have a good weekend. And we look forward to connecting again soon. Thank you.
Thank you.
Okay, so with that, let's quickly check what the Nifty is doing in the pre-open session. It's still down by about 50 points. But like we were discussing with Mayuresh, new age, right? Where's the technology? Or one space where the market has had some proof of concept, obviously, in terms of India's own tech plays. That's the platform companies, Swiggy and Zomato. So that's what we're putting the spotlight on now. Karan Torani of Elara Capital joins in. He, of course, tracks these companies very, very carefully. Karan, great to have you with us this Friday. Finally, we're making the interview happen. So welcome to Moneycontrol.
Thanks, Surabhi. I'm happy as well. Finally, it's happening.
Yeah, absolutely. So we've picked a good week, Karan, to discuss these stocks. I'm just pulling up Eternal and seeing what's happened. Yeah, 5-6% lower this week. And this week also had a lot of news and noise around what the Karnataka state government is doing with gig workers. I think they have some kind of a social security, not a cess, but it's a levy that they're going to put on these platform companies. And then there's Q3 as well. I mean, Q3 trends to discuss. You've largely remained optimistic on platform companies. So I'm going to start right there to revise that view for our viewers. You are positive on both Eternal and on Swiggy. I think Swiggy you upgraded after the Q3 results, right?
Yes, Surabhi. Hi, morning. So absolutely, I think if you look at Swiggy, we upgraded the stock this quarter largely because the stock saw a sharp correction. Valuations actually came down by anywhere in the range of 20-25%. And post the results, also the stock had a negative reaction. So what I would like to say here is that I think there is some intrinsic value for the food business. The food business obviously is a duopoly market right now. Swiggy is the number 2 player. We don't see any threat of a new entrant coming in, so they'll probably maintain that market share. Secondly, I think Swiggy, in terms of the food business profitability, the metrics have been improving consistently over the last 3 to 4 quarters. They are obviously lower as compared to Zomato on the food business side, but 3% EBITDA as a percentage of GOV is where they are. So potentially, they will go to that 4 to 5% kind of a band as per management guidance. So I think putting that into perspective, it's very clear that one should actually value the food business on an intrinsic value standpoint. And given the kind of scale gap versus Zomato food, and given the kind of valuation discount one would have versus Zomato, because Zomato obviously is the number 1 player, we believe the intrinsic value of the food business alone is anywhere in the range of 65 to 70,000 crores.
So, what's also interesting, by the way, viewers, this morning there is news on Swiggy. Swiggy has shut down its 10-minute food delivery service. It's called Snack. The company has been talking about profit pressures, and they say that it doesn't it's not worthwhile for them. So, Karan, on food delivery itself, though the business is, of course, is far more mature, and then I'll come to quick commerce, in a second. On food delivery, how do you rate the improvement in the profitability metrics? Because every now and then, competition does come back in, discounting does come back in, and Zepto's 10-minute cafe, I mean, everyone who's on these apps knows that Zepto always keeps the pressure going. So what to expect on the food delivery business for both of these companies going forward?
So on the food delivery side, I think closing Snack, it was a part of the platform valuation initiative. So this will have a positive impact in terms of the consolidated EBITDA and not specifically the food segment. This segment was making losses of anywhere in the range of 170 to 200 crores on annualized basis. And Swiggy, if you look at as a company, they are still making EBITDA losses of about 3.5, 4,000 crores because of the higher losses in the QC business that they have. So I think this will actually lead to a lower amount of losses because of the snack business shutting down. Secondly, on the outlook on the food business side, it's very clear that food business is now going to go at steady state. One may not expect food delivery growth rate to be at 20%, 25% kind of numbers, what we've seen historically. I think on a steady state beyond FY26, beyond FY27, 28, food delivery business growth rate could converge more towards 17 to 18%. And as I mentioned, that there are levers at play here in terms of improving profitability, both for Zomato in a small manner and for Swiggy as well, because there's no threat of new entrant here. Third thing, what is happening interestingly here is that the frequency is a bigger driver here. So at a market which is duopolistic in nature, you don't need to go aggressive in terms of user acquisition cost. So user growth actually sees a convergence more towards mid to high single digit kind of a number, and frequency is a bigger driver of the 16-17% growth they're talking about, because AOV typically doesn't grow beyond 3 to 4% on annualized basis.
Got that. Okay, now I'm going to talk about quick commerce, Karan, and here I think the big headline of the quarter was that Eternal, with its quick commerce business Blinkit, basically Blinkit has turned adjusted EBITDA positive, which sounds great. But what does it really mean? I mean, what is the final path to profitability? Because they're still setting up more stores, right?
Yes, absolutely. I think Eternal is the only company which has clearly maintained both the balance between growth and profitability. They are adding stores, they're doubling down on stores every 18 to 24 months. I think in the next 1.5 to 2 years, they have guidance for a store of more than 3,000 store counts, which is close to 1,800 today. So, and plus with this expansion, and second with such kind of high competitive intensity, price wars in some situations, they are able to have a break-even with the QC business at this scale. So I think it's very commendable the way they are executing. I think that's the reason why we probably maintain our preference and a strong buy call on Eternal, primarily because of the QC business. As far as Swiggy is concerned, I think last couple of quarters, the commentary has indicated that they want to now focus on profitability, because this game is not sustainable if you don't go for good quality growth. Probably they are not able to blend this growth and profitability. And I think that's the reason, to protect profitability or to make sure that the losses actually come off, because they are given a guidance of contribution break-even by Q1 FY27. They will have to take a compromise on growth, which is going to come into the numbers in the coming quarters. But yes, I think if Swiggy also does execute well on profitability despite lower growth, basis the current valuations in the food business side and the cash on books and the other business valuations, the QC business largely is available free today. So I think that's the potential upside that one should start valuing the QC business 2-3 quarters down the line if the losses actually come off significantly.
Okay, Karan, give me just a second because the market's open. Let me quickly run through the rates and then we'll come back and continue the conversation. Okay, so 35 to 40 points lower. That's what the Nifty is off to, pretty in line with the pre-open session. And you have tech sliding all over again. So look at Infosys, TCS, Wipro. These are the early stocks. And you can see, I mean, Nifty Bank is flat. It's trying to offer some sort of a counter. The mid-cap index is also completely flat. So it's not a major slide or anything. But the pressure from the IT side of the market is unrelenting. That's the problem. Let's pull up the Nifty losers and you'll see what I mean. Because the losers are all these IT names. Infosys is down almost 2%. HCL Tech is down about 1%. Wipro is down about 0.5%. And TCS is lowered by about 0.5%. So that's the problem area of the market. Actually, the downside is only because of these IT names. Otherwise, not much is lower. There's Bajaj Finance, which is about 0.25% lower, a little bit of a fall on Ultratech Cement. There is Apollo Hospitals, but that's it. I mean, then your list of losers ends pretty much here. Now let's look at Nifty gainers, and that's where banks, large banks are offering a good cushion. You've got like SBI, for instance, about 0.5% higher. ONGC is continuing its north march. Thanks to this big surge in oil prices, it's the best performing stock on the Nifty right now. Titan is showing some gains as NTPC, Power Grid. Some of the power stocks actually are looking quite good this morning. There's Hindalco, Maruti, Tata Consumer, Nestle. Consumer stocks, largely speaking, are positive. And then you have some of the financial names like ICICI Bank and SBI. So that's what's on the green side. And the sum and substance of this is a very flat Nifty. You have banks and consumer slightly positive, and you've got IT basically negative. And those are the two offsets at this juncture. Let me see what's happening with some of the stocks in news now. Novartis India, that's the stock to focus on. 15% higher because the global parent is selling off stake, a large chunk of its stake, almost 70+% to Chris Capital. It's going to be triggering an open offer. Stocks surging 15% up as we speak, 950. ABB is actually looking quite good after numbers, 4.5%. The order inflow picture seemed to be quite solid with ABB, and that's what the market's going with. Not focusing so much on the profitability fall because that was perhaps expected. 4% up on ABB. Then there is a CIE Automotive, which is also up. But again, in this space as well, watch out for oil marketing companies. That oil trade is very clear. ONGC up, and oil marketing companies like HPCL, BPCL, IOC, all of those stocks are down between 0.5% to almost 1.5%. HPCL is down, for instance, 1.2% at this juncture. Let's get the oil marketing companies on the screen. That's what the headline is like. Apart from that, the mid-cap index is completely flat. There's not much going on. That's ONGC, which is up. You should bring up HPCL, BPCL and IOC. Those are the stocks, the oil marketing companies. Lenskart is reacting positively. There is an initiation report, I think it's Motilal Oswal, that's written on Lenskart today, and they feel a price target of 600 is possible, and that stock's reacting well to that brokerage note, 2.5% up on Lenskart at this point. And those are the oil marketing companies that I was referring to earlier. Otherwise, it's fairly quiet on the mid-cap screen as well. Not too much moving around. It's all IT, Netware, Persistent, First Source. These are the names. Newgen Software. These are the names where the pain and the pressure is showing up. So those are the mid-cap gainers. You can see a lot of financials there. And if you flip that with mid-cap losers, you'll find a lot of mid-cap IT stocks on that screen as well. So we'll keep rotating and you'll see what I mean. That's where the pressure really is. Coforge, Persistent, those are the stocks that are down. But overall, at the index level, the market is totally quiet. So it seems India kind of preempted this global fall, which is why, at least for the time being, the Nifty is trying to hold its own. That's the market for you. So, Karan, okay, so coming back, we've discussed the quick commerce business, we've discussed the food delivery business. Now, what about this added compensation to gig workers? I think it's a very nominal fee right now in Karnataka. It's not even 1 rupee. I think it's less than 1 rupee. But is that a new risk that investors need to be aware of?
Right. I think this announcement came a couple of months back, wherein the government actually issued a draft bill on code of conduct. And this was primarily to do with the welfare of the gig workers, wherein they were actually supposed to give more incentives to the gig workers. The incentives were in the form of term plan, Mediclaim, insurance, maternity, accident policy, and so on and so forth. If you look at the current context here, some of these, or rather both of these companies, are giving some bit of incentive to the gig workers, right? But the bill clearly mentioned that the incentives have to be either 2% of revenue or 5% of gig worker payout, whichever is the larger number. So as per our assessment, this potentially could have a negative impact of anywhere in the range of 2 to 3 rupees on a per order basis if these companies were to increase the incentive benefit for the gig workers. However, the incentive will only be implemented once the final bill is passed, because this bill is in draft stage right now. That's the first thing. Secondly, there could be some bit of delays in terms of the bill being passed, because primarily this bill will also require state approvals. So some states may try to rejig these numbers in terms of payouts and the numbers which I mentioned in the bill, which could lead to a higher risk or a higher payout. But as of now, 2 to 3 rupees per order is a smaller number. And I think this will eventually be recovered from the consumer base. And again, herein, players like Blinkit are in a better situation as compared to Instamart, because their customer is more premium in nature. they are making lower losses or break even in the QC business. And even the food margins are significantly higher as compared to the second player. So I think this does have a negative impact. But in the near term, if this is only 2 to 3 rupees per order, which means that if there is no major rejig in terms of the draft bill today, then the impact is quite subdued. But if at all there's a major rejig in terms of draft bill wherein they actually try to increase the incentive benefit or change some kind of percentage payout amount, then that could be a dampener for the platform companies.
Okay, so that's as far as that headwind of any additional benefits for gig workers goes. But okay, let's come to the overall picture, Karan. And you are very positive on these companies. I think your price target on Eternal is above 400. Yeah, now we've got it on the screen. 415 is your price target. You've upgraded Swiggy also. So what is the case here, and what could be the downside risk, if any?
So the case for Swiggy is well explained. I think we mentioned that the QC business is not driving any value basis the food business, the cash on books after the burn in the next 2 years, and the other businesses. So that is the QC part, which will get some valuation if at all they execute well on profitability. That is the trigger there. The risk for Swiggy, what we foresee is that if the margins in the food business don't improve, so there's a reasonable amount of gap between Zomato and Swiggy in the food business margin. So the food business margin for Swiggy don't move towards that 4 or 5% band in the next 3 to 4 quarters. You may not see re-rating of valuation because clearly then the discount of the food business valuation versus Zomato will increase further. So that's the risk on Swiggy. On Eternal, I think it's quite clear that the food business execution remains to be on track. We don't see any kind of concerns both on growth and profitability. There may be certain quarters where Zomato food could slightly underperform on growth front, maybe 1 to 2 percentage points versus a Swiggy. But that shouldn't hamper the Zomato food business valuations much because they operate at a premium profitability and at a larger scale and the number one player. So that's where the food business margins are. In terms of the QC business, if you look at Blinkit, I think therein as well, what we await is profitability. So Blinkit is now operating at a reasonable amount of scale. I think it's a matter of time, the next 2 to 3 quarters, competitive intensity, if not, we'll see an entire cool off, but yes, we'll see some kind of stabilization because we don't see these kind of price wars sustaining. We believe that Swiggy probably was the first casualty of this, wherein they actually try to focus on good quality growth and focus on profitability. We believe that other players will also get into this. Players like Zepto in a matter of time will also have to curtail discounts by a big margin in the next 2 to 3 months. And the biggest beneficiary of that will also be Blinkit because they're market leaders. So once we see part of profitability improving, that's going to be the trigger for Blinkit to see re-rating of valuation multiple. The risk for Blinkit, of course, is that this competitive intensity prevails for the year to 18 months, which will probably have a negative impact on their expansion plans, potentially, if at all, in the medium term.
Okay, so basically high competitive intensity, that's the only real risk, Karan, right? Otherwise, these companies are well on track of achieving their profitability targets.
Yes, absolutely. I think the discounts or the price war situation
is the only risk.
Yeah, I think if you look at the price war and the discount situation, the worst is largely behind us. And I think things are only going to improve from here on. Now, whether it takes 3 months, 6 months, or 9 months, that is the key monitorable.
Okay. Basically, I should quickly go and order my coffee now because another 3 months, those discounts will go away. I think that's my takeaway on a lighter note from this conversation. But very helpful, Karan. Thank you so much for joining in. I think it's a good conversation for a Friday morning. Lots of food for thought as we speak. But thank you for explaining your positive stance on some of these platform companies. You have a great Friday, and thank you for joining in.
Thank you, Surabhi. You too have a great Friday.
Thank you. Thank you. All right. Well, the screen is showing a little bit of red. The Nifty is down about 30 to 33 points. Let's do one thing. Let's tell you about all the movers and shakers. Nifty, mid-cap index. IT continues to be the big drag. Check out these stock rates. We'll be back with the next guest in just a minute. It's largely IT that's responsible for this fall. So let's bring up the stocks and we'll be back with our next guest in just a bit. Welcome back. So the market continues to be fairly range bound. It's financials that are providing some support today. IT continues to be in a bit of a weak spot. Well, it's time to welcome in our next guest on the show. Ankit Jain, who's the senior fund manager at Mirae Asset Investment Managers, is joining in this morning. Ankit, thank you so much for being with us. I'm so glad we can finally connect, and welcome to Moneycontrol.
Yeah, hi. Hi, good morning to all the viewers. Thank you.
So, Ankit, how is 2026 going so far?
Yeah, no, so Surabhi, I mean, if we really look into it, market is clearly at a very, very interesting juncture at this point in time. After 18 months of, let's say, consolidation, we have seen, clearly at this point in time, I mean, outlook is looking, I think, fairly interesting, and even valuations are now, let's say, far more reasonable. So we have to look market in the context of the underlying earnings growth and what valuations we are paying in. In that bucket, clearly, on the one hand, we have started seeing that sign of earnings stabilization coming in. I mean, with actually back-to-back last couple of quarters, if you look into almost 14-15% PAT growth for Nifty 500 companies. And in that context, clearly, I mean, we have seen basically incremental earning downgrades has actually come down. And plus, on top of that, if you look into with the trade deal announcement and all, I mean, I think all of this is getting discounted by the market. So actually, in our view, frankly, market is actually very well poised. Valuations are far more attractive at this point in time, and we actually remain very, very constructive at this point.
Okay. So, since you are saying you're very constructive, let's talk about the earnings growth projections, Ankit, first of all. What, I mean, among the large basket of stocks that Mirae owns across funds, how did you, rate and rank the earnings season? And in terms of improvement in earnings in FY27, what are the estimates that you're working with now?
Yeah, so Surabhi, if you look into, let's talk about Nifty 500, I mean, which is a very broad-based representation of the market. Aggregate earning growth last quarter, just the quarter gone by, has been 16%, which has been a decent jump. A quarter prior has been 14%. So slight improvement there. Yes, some part of festive and all might have also added. But if you look into this trajectory, let's say from quarter 2 of fiscal year 25 till quarter 1 of fiscal year 26, earnings growth has been in the range of 6 to 7, 8%, 9% sort of a basket. So from there, clearly, I mean, the improvement to mid-teen number is a significant jump. And clearly, that is also reflective in overall macro data points as well, right? I mean, after all the fiscal and monetary impetus being given by the government in last 1 year, which is reflective in overall, GDP growth improving in and finally percolating down onto the earnings side also. And it is not only about the bottom line growth. I mean, the key indicator is also to do with the top line growth, right? The top line growth, which has been struggling at, let's say, 5-6%, again, going back quarter 2 of 25 till quarter 1 of 26. Last quarter has improved to almost 10.5-11%, so which is a pretty healthy jump. And to that extent, I believe at this point in time, I think earnings expectations are far more realistic. If you look into large cap, mid cap, small cap, whichever basket you try to look into, I think 12-13% sort of a earnings CAGR for large cap and 16-18% for mid and small cap. I mean, those are actually realistic number at this point in time, and we do see very actually limited downgrades on actually some of these expectations.
So, okay, let's understand the portfolio construct since you're overall positive, Ankit. I'm just looking at your latest fact sheet, and let's look at the large and mid cap fund. Which I think is something that is one of the funds that Ankit looks at. And here, if I look at just the concentration of sectors, so banks are a large part of this fund, 23%. There's also IT in this fund, about 7.5%. Then there is pharma, which is about 8%, retailing, so on and so forth. So let's start right there. So financials would be your most preferred space in the market now? And if yes, and Ankit, what part of financials? Because it's a very large universe. Private banks, PSU banks, and then you have these capital market stocks that have become so volatile because of regulation.
Yeah, they're absolutely right. So we are quite positive on banking and financial sector because clearly, I mean, the issues around liquidity challenges which has been faced, let's say, because of which credit growth has sort of slowed down to 9-10%, let's say around 12 months back. Most of that has sort of got actually resolved because we have seen rate cuts coupled with lot of I mean regulatory measures being undertaken by RBI that is now reflecting in credit growth improving in. If you go by December, January sort of a data that is tracking more than 14% credit growth numbers. So clearly one top-down credit growth outlook is improving. Second, on top of that, if you look into this entire navigation around the margin cycle during the rate cut environment, I think that has panned out fairly well. So to that extent, from here on, I think outlook on overall earnings are looking fairly good because we are also not seeing any sort of a bigger pockets of asset quality concern at this point in time. So to that extent, I think profitability should stack up well for this sector. Within this, at this point in time, we are favoring more large private sector banks because there, I think valuations comfort is far more reasonable. They are trading at maybe long-term average and in certain cases at a discount as well. PSU banks has done exceedingly well in last couple of years, and rightly so because their credit growth gap versus the market has actually come down. So incremental market share loss has not been much in a tough liquidity environment because they were flush with liquidity. So they have done well on that count. And second, even ROE has seen a pretty good improvement. But having said that, from here on, incrementally, even private sector banks should start doing well on the growth side of it. And plus, valuations are far more reasonable versus the history. So actually, that is one. Second, within this bucket, let's say NBFCs and all, incrementally, we are not so positive on NBFCs, though we are having exposure. But clearly, we will prefer the private sector bank much more than any other subsegment within this sector.
Okay. Ankit, I must come to the very interesting part of your portfolio, which is IT services. I noticed that, I mean, for instance, TCS is one of the top holdings in some of the funds. What have you made of this absolute upheaval, chaos, roller coaster on IT? And are you prepared to keep the faith through this drawdown?
Yeah, so Surabhi, if you look into IT weights as to be seen in the context of the benchmark sector weight, so we are underweight on the overall IT sector, while you might be seeing some of the exposure out there. But with respect to benchmark sectoral weight, we are underweight. And as you rightly pointed out, I think some of these new information which we are getting on account of built up of the AI and the potential impact on the IT services sector. I think this is clearly versus the past. If you go back in the history, 2-3 decades of Indian IT services, I mean, this sort of a technology shift is something I think extent is far bigger than anything else what we have seen in the past, be it mainframe to cloud migration or maybe digital. I mean, built up what we have seen because it is I think complete shift where the underlying clients also have to invest into some part of hardware, basically apart from the software side of it, keeping the budget, I mean, the overall budget, I mean, intact. So to that extent, I think upfront deflationary pressure to most of these IT companies will be high, and which is, I think, pretty much reflected in actually pricing pressure. I mean, we have been seeing that while volume growth and all outlook might be improving with the, I mean, with the increased application uses, But but clearly pricing deflation is here to stay. So to that extent, no, first of all, top down itself, no, I think top line growth construct for the sector has been 6 to 8% for the large caps mostly. And plus on top of that, in case if some of these pricing pressures and all are here to stay, clearly, I think growth outlook is going to be maybe mid-single digit in the best case. I mean, as far as the large caps are concerned. So in that context, no, while sector has seen a drawdown, I mean valuations in the historical context now, even versus pre-COVID, no, they have come down at pre-COVID valuations or even maybe slightly discount to that. But having said that, at this point in time, given the uncertainties around on the earnings, we will rather wait much more to get actually more clarity around before turning more sort of a constructive on the sector.
Okay, so need to wait for maybe the dust to settle, for more clarity to emerge, and maybe over the next 2-3 quarters, we'll have a very clear view from the companies in terms of how much they're able to scale up on the AI curve and the AI value chain. So perhaps it's a wait and watch. Understand that. Ankit, so now for the next several quarters, I mean, investors who are looking to take slightly longer bets, longer term, medium term bets, banks we've discussed, I mean, financial services and banks, that seems to be a very steady zone. What about industrials and capex? I mean, these stocks are not really the flavor anymore. They were in 23, 24, but then they've kind of gone out of favor. But it's a very large universe. I mean, capex is a very huge term. Within that, where do you see evidence of sustained earnings, sustained order flows, order wins? What do you like here, if anything at all?
No, so we are underweight on this entire industrial capital goods sector as well, because clearly, I mean, I think the valuations are very, very
okay.
high. And the recovery in capex is actually not very broad based. No, it has definitely been there into certain sub-segments. And plus, no, I think earnings ask rate and margin ask rate in actually many of these sectors has been fairly high. And in that context, no chances of earnings downgrade actually has been high. Some part of that has played out in last 12 to 18 months. And in that context, valuations are still expensive. But the sectors where we do find more value and actually, I mean, with some of these US EU trade deal, also getting announced and hopefully, I mean, a significant benefit coming in over, let's say, next 12 to 24 months time frame as such, and actually it can be very, very significant across many of the labor intensive areas, be it agri, textile, chemical, gems and jewelry, engineering goods. So to that extent. And plus, on top of that, the extent of currency depreciation, right? I mean, versus Chinese yuan or maybe euro. So in that context, we do find significant value in maybe pharmaceuticals, which includes CRO, CDMO. I think. I mean, significant opportunities out there. That is one part of it. Chemicals also actually is getting a lot more interesting at this point in time because India do export quite a bit to Europe as well as US side of it. Industrial consumable might be another bucket which is looking interesting. And then maybe logistics as a sub-segment. I mean, in case if your EXIM trade has to improve in. Some of those sub-segments are looking very, very interesting at this point in time.
Okay. So final thoughts, Ankit. You say you're constructive on the market. You've outlined some of the sectors that you like. But overall, you expect the market to head higher by the time we are in the second half, by the time, say, Diwali of this year?
Yeah, absolutely. I mean, if you look into markets, go back in the history has always been trended in line with the underlying earnings growth. Yes, I mean, there might always be a delay. Versus the underlying earnings growth, depending on to the flows and so many other factors around. But having said that, at this point in time, starting point of valuations are no longer super expensive as what the case 18 months back. versus historical valuation premium is hardly anything. I mean, large caps are more or less trending 1 year forward 20x, which is in line with 19.5 historical average, and even mid cap and small cap. No, versus historical average premium has come down to 10-20%, which has gone very, very high. I mean, 18 months back. And in that context, if the earnings growth comfort is there, low to mid teens, then actually I don't see any reason why. Why actually market should also not track in line with the underlying earnings growth from here.
Okay. All right. That sounds optimistic, and we hope that trajectory plays out. Mutual fund investors have been patiently waiting for a bigger turnaround and for their portfolios to do well. Thank you very much for that, Ankit. Great conversation. You have a good Friday and a good weekend, and we look forward to connecting again soon. Thank you.
Thank you, Surabhi. Thanks.
Thank you. Okay. Well, the market has turned around. Guess what? Check the Nifty and the Sensex, check the mid-cap index. The color is suddenly green. And banks are leading the way. The bank Nifty is up about 0.4% right now. So it's a very good-looking screen, actually. And yes, there we go. That's the recovery. We should actually fire up the Nifty gainers. Let's get the gainers on the screen, and you'll find a lot of financial stocks because the Nifty bank is the one that's leading the recovery. But there are a lot of material stocks as well that are doing well. Coal India, for instance, that's the one, 2% up. Bharat Electronics, ONGC anyways had a great run since yesterday. NTPC is doing well. So look at this. I mean, PSUs, full charge ahead. NTPC, Coal India, BEL, ONGC, PSUs all the way. Then there's Titan, Hindalco doing well. HUL and L&T are adding to the Nifty's tally. Some heavyweights are really driving things up. Eicher Motors, Reddy's, Reliance is up about 0.5% as well. So overall, it's looking pretty good. The only down pocket in the market right now really is IT. That's the only problem area. Otherwise, the dip has been bought and the lows have been protected. That's the story really. Those are some of your losers on the downside. Let's do one thing. Let's run through some of the interesting broker notes of the morning as well before we invite our next guest. A couple of these notes have come in on the IT stocks. Some of them are on interesting earnings that came out in the last 24 hours. So let's start off. UBS is the first brokerage note that we've got for you. And this is a call coming in on ABB India from UBS. It's a neutral call. Their target price is 5,310 rupees a share. And UBS is saying that the order book, the order inflow, that is, the revenue and the adjusted EBITDA, all were above estimates. And the biggest beat was actually on the order inflow, 23% beat compared to what was anticipated. And these were large wins in data centers, automotive, railways, and metals. And all of this is making the street fairly optimistic. By the way, ABB has been up 4-5% since the morning. So that's ABB. Now let's talk about TCS. Morgan Stanley has come out with a call on TCS. And they retain their positive stance. They've got an overweight rating on TCS. Their target price is 3,540 rupees a share. And Morgan Stanley feels that the AI partnerships that TCS is now forging, they're very similar to the hyperscale tie-ups that were being announced during the cloud era, when cloud adoption was taking place. So similarly, now these partnerships with AI companies will probably work well for the firm. They're saying that advances in data centers after that TPG Hypervault investment are also perhaps moving in the right direction. And OpenAI becomes the first client, first 100 megawatts will be used up by OpenAI. So it's all sounding very, very positive. It's all sounding very positive, and it's giving a long-term optionality to the valuations as well. And that's what explains Morgan Stanley's positive view. Now let's talk about CLSA. CLSA has a call on the power sector. They're saying that climate change related weakness will be an opportunity to buy into the space. They're saying strong capacity additions in the non-fossil fuel as well as in the fossil energy space are something to watch. Solar generation remains weak, and there is a structural shift that is favoring independent power producers. This would benefit stocks like NTPC, NHPC, CESC. And that explains how some of these names like NTPC on the large cap screen are doing very well this Friday morning. So that's CLSA on power sector. CLSA has also come out with a note on autos. They're saying that premium brands continue to flourish. The entry-level SUV segment and the 125cc mobile segment These are the segments that are going to be shining the most over the next couple of months as the GST rate cut benefits continue to flow through. TVS Motors and Royal Enfield will continue to outperform. That's their sense in the two-wheeler space. And M&M will continue to outshine in the passenger vehicle space thanks to a lot of strong launches lined up and strong execution ahead. So M&M is actually their top pick in PVs, and their top pick in two-wheelers is Bajaj Auto. Finally, moving to Jefferies on industrials. Jefferies says the government may allow Chinese competition in the power generation and equipment space. BHEL could be impacted if there are large imports coming in on these power equipments. Then there is L&T. 9% of their order book is exposed to this segment, and it could be offset through diversification in other segments. So those are some of the notes coming through. That's Jefferies on industrials. They're positive on Siemens Energy and Hitachi Energy. Okay, so those are some of the broker stocks, those are some of the stocks that are in focus on account of interesting brokerage notes today. But for the timing, it's time for our special segment with Moneycontrol Pro. And Moneycontrol Pro has done a very comprehensive analysis of the Q3 earnings, and it has come out with its own strategy note as well. And we have a Madhuchanda Day of Moneycontrol Pro joining in to give us a sense of how the third quarter has really shaped up. Madhu, good morning. Thank you so much for joining in. So I know that, and by the way, viewers, Moneycontrol Pro tracks over 200 companies, right? Madhu, your team tracks over 200 companies.
Yeah.
Okay.
Hello.
So tell us about the Q3 report card. How did it stack up? Madhu, yes, we can hear you.
Yeah, Q3 fortunately was a good report card amid the gloom in the markets. So Nifty earnings growth was in high single digits. But what is more interesting for all of us to learn is the positivity in the broad markets. I mean, Nifty 500 typically, which is a broader representation where a lot of investor wealth is basically concentrated, that earnings grew in mid-teens, which is a very positive signal. And we have already seen, a lot of fiscal stimulus working and the monetary stimulus. And finally, that got reflected in the earnings momentum in Q3, which is definitely a good news for the markets and the investors.
Okay. So let's go over some of the sectoral trends, Madhu. Which are the sectors that really fared well, which were maybe even above estimates, where the growth visibility remains strong in the third quarter?
See, I mean, if you talk about the sectors, it is the usual suspect. I mean, what was kind of leading the charge, in fact, which was not there before, was the consumer discretionary, especially led by auto. As we all know, the auto numbers have really bumped up following the GST rationalization. So it was a strong quarter in terms of top line growth for automobile, although there was a tad bit of margin pressure, but overall auto companies did well, barring, Tata Motors passenger vehicle, where there was this cyber attack, which was kind of known. But the positive sentiment on the consumption side also had spread beyond auto. And one of the standout sector which we would like to call out was the jewelry segment. Normally, one would have expected that jewelry demand would be subdued because of the sharp rally in gold prices. Although there was a little bit of a volume impact, but that was more than offset by, the value growth. And what is more interesting as far as jewelry is concerned, one would think that, how would people be buying jewelry when the prices are so high? But there is a large component of exchange which happens in the jewelry, where people really bring their old jewelry and then get a new one made. So that is a good 30-40% of jewelry demand. And the companies are also working on lower carat jewelry, lightweight jewelry, etc. And this coupled with the wedding season, the festive season, really brought a lot of positivity to the jewelry segment, and mostly all the jewelry stocks did well. We would also like to call out, the the positive momentum which is building up in other spaces were not really overt in the quarter, but the guidance is positive. As far as QSR is concerned, it's stabilizing. As far as the apparel is concerned, it was not a great quarter because of the timing of the festive season, but overall the guidance is quite positive. Hotels continue to do well. So on the consumption side, overall the momentum seems to be coming back. The other pocket where we felt and we are very positive on is financials, because the loan growth is clearly picking up, and with this consumption momentum that should also kind of propel loan growth going forward. The other thing which is important is most of the rate cut is getting priced in, and Q4 would be the kind of the last quarter when we would see margin compression. Most of the financials, especially the banks, have managed the margin pretty well, and asset quality continues to be at its best. So financials, especially banks, is one space where we expect things to really improve from here on. And in fact, Q3 was also a good quarter. So I would really call out consumption and financials, along with telecom, of course. These were some of the strong pockets, and which we expect the momentum to continue going beyond Q4.
Okay, since we're talking financials, Madhu, let me also welcome Neha from your team, because I think Neha specifically looked at some of the microfinance plays in the market. And Neha, thank you for joining this conversation, because while Madhu is giving us the overall picture, we specifically wanted to ask you about trends that you picked up in microfinance companies. So why don't you tell us, how are the profitability metrics, and has microfinance finally turned a corner?
Yeah, so it was a very interesting quarter for microfinance lenders, especially the non-bank MFIs. What we saw was that there was a strong growth in earnings. Last quarter, some of them, last year, the same quarter, some of them had reported loss. But this year there was profit, and this quarter was a kind of an inflection for this non-bank microfinance lenders. They had faced a very difficult year last year, that is FY25, and this was due to certain structural issues in the sector, like borrower level over leveraging. Then there was this self-regulatory organization that had imposed certain safeguards, which led to stringent underwriting norms, and disbursements were impacted, so there was no AUM growth. The asset quality was impacted last year. But interestingly, all this headwind seems to be normalizing for the sector. There is the borrower level over leveraging seems to be reducing. There is asset quality is also stabilizing. Also, the loan growth has started to pick up for these players. So overall, the sector is poised for a revival, definitely. Especially going into FY27, we will see a strong earnings growth for NBFC MFIs.
Okay. And Neha, you want to call out any of the specific stocks that you track? I mean, specific trends with those companies?
Yeah, so interestingly, Credit Access Grameen, which is the largest non-bank microfinance lender with a loan book of around 27,000 crore, reported a very good set of numbers. It is trading at a very premium valuation of around, say, 2.2 times FY28. However, if we look at the past record or the history of this company, historically it has traded at about 3.5 book value, forward book value also. Also, the return on asset has a lot of scope for further improvement. Historically, it used to report ROAs of above 4%, and in Q3, the company reported ROA of 3.5%, indicating there is a scope of further improvement. But the most important thing and interesting thing for Credit Access is that its parentage, which is the Credit Access Group, is looking to sell its stake in the company. And some of the largest private banks like Axis Bank and HDFC Bank are evaluating the opportunity. And this is as per the news report. Now, so which means that despite trading at a premium valuation, there is a scope of further re-rating going by, the potential stake sale in the company that can happen. And this will obviously be supported by strong earnings growth. Also, we had looked at what the past M&A transaction in the sector, which was like IndusInd Bank taking over Bharat Financial, and that had happened at 3.8 times forward book value. And currently, Credit Access is trading at around 2.2 times forward book value. So, even the past transaction indicates that though the valuation seems premium currently, there is a scope of re-rating. So that is one stock. The other one is
Okay.
Muthoot Microfinance.
And what about Muthoot?
Yeah, so Muthoot
Yeah,
Microfinance is another
Muthoot's
stock.
microfinance business. How did that fare?
Yeah, so it is doing well. It is relatively a smaller player with a low AUM of around 13,000 crore. And it has also done well in terms of earnings growth, asset quality stabilizing. There is significant fall in credit cost. Management's guidance is also very upbeat for FY27. So everything is falling in place with the stock. The valuation wise, it is looking very attractive. It trades at a significant discount to Credit Access Grameen. In the terms of valuation, it is trading at around 1.1 times FY28 book value, which is like a huge discount to Credit Access Grameen. So, and its return ratios are obviously improving. So, Muthoot Microfin also is looking good. However, from an investor's perspective, I would like to point out one specific thing is that both these players have a huge geographical concentration. Their loan book is concentrated, especially in South India. Certain states contribute more than 50%. I mean, 3 states contribute more than 50% of their loan book. Now, both states have exposure to Tamil Nadu, and there is assembly election that is lined up in the state. And historically, we have seen that the collection efficiencies typically slows down as the state goes to the poll. So that is something that investor needs to keep in mind. Otherwise,
Yeah.
from a return perspective, the earnings growth looks improving.
Okay, so things seem to be on track for some of these microfinance players, and for Credit Access, obviously, it's that big M&A deal that everybody's waiting for. Who will finally snap up Credit Access? That's the big question. Got that, Neha. Thank you very much. Very, very helpful analysis, a specific spotlight on microfinance. But Madhu, I want to come back to you on some of the other bigger sectors. So clearly, like you described, the consumer sector largely did very well. Autos, jewelry stocks, like you described. Now, what's happening with industrials? Just this morning, we had numbers from ABB, and their order inflow seemed to be very, very solid. But what about the overall industrials and infrastructure space? What trends emerge from the third quarter?
See, industrials is a very diverse space, and we cannot paint all of them with the same brush. So there were, I would say, notable surprises in terms of the order inflow, the execution, and the guidance for a bellwether stock like Lawson and Tupro. They clearly called out that the order inflow momentum is improving, especially from the domestic side, which was not there before, because L&T during the slowdown phase was banking a lot on its overseas order. And they also called out that they are seeing nascent signs of private capex improving. And as you know, that with the improvement in the consumption sentiment, with the improvement in overall, the consumption engine, the capacity utilization should start improving. And once the capacity utilization improves, you would see private capex coming back. So to that extent, that pocket also looks interesting. Another thing which I would like to call out are the new opportunities, like industrials. The color of industrials is also changing. For instance, a stock like Cummins, which really did well in the quarter, and in addition to their export opportunity, they are now seeing a great opportunity from things like data center, which are a new investment, as we call them, AI factory. So this AI factory is also going to open up a lot of investment opportunity for individuals, for say power T&D, for cables and wires. So one has to be very selective, but there will be pockets of pockets of opportunity, and where investors can look for long-term investment opportunity, definitely in industrials as well. And I would also like to point out another pocket which we track very closely and we like, which is water. Something like Viatech, Weber, where there's a huge opportunity because clean water is going to be a requirement not only for household but also for industries, and there's going to be huge water requirement for running power plants as well. So water infrastructure is another pocket which we think makes a strong case for a long-term investment.
Okay, all right, got that. Madhu, final question on valuations now. At the end of the third quarter, where are we on the overall multiple? And I mean, that's always the biggest point of debate, right? That whether valuations have now corrected enough.
Like the large cap. So we are close to about 20.4 times 1 year forward earnings, which is at a tad discount to the long period average of 20.9 times. Having said that, we have done our own proprietary model to, we keep doing that to figure out, what are the short-term pressures, etc. in the market. And that seems to suggest that, the maximum downward pressure on the market is to the extent of 5 to 6%. And that's why we feel that, given the backdrop, when the macro is improving, the earnings picture has really improved, the outlook for the next quarter and beyond is looking promising. We feel that, markets are interestingly poised for investors.
Oh, yes, absolutely. And earnings is that basic fuel that fires up any bull market right now. If earnings have started improving, then that definitely perhaps sets us up in the right direction. Great conversation, Madhu. Thank you so much for joining in with that comprehensive analysis from Moneycontrol Pro. And viewers, remember, you can get all the details and further stock-specific analysis, stock-specific advice, buy and sell recommendations from our technical experts as well, all of that on Moneycontrol Pro. So make sure you get that subscription and take the benefit of all the details that are there. Thanks very much, Madhu. You have a good day.
Thank you.
Okay, all right. Well, with that, we are almost out of time on this edition of the show. The market's looking actually very, very good. The Nifty is now in cruise control mode. The morning dip has been bought and the index is actually up 50 points as we speak. The mid-cap index is up about 0.3% and the bank Nifty is looking the best. The bank Nifty is up a whole 0.5% right now. So, as we take your leave on opening bell, that's the screen. And the large part of that is coming in from banks actually. Bank Nifty is looking very, very solid and strong. And some other large cap stocks are also driving things higher. Now, as we take your leave on this edition of Opening Bell, let me actually leave you with some very interesting snippets from day 4 of the AI Impact Summit in New Delhi. It featured some of the biggest global voices. Prime Minister Narendra Modi, of course, was there, who said that AI is not just making machines smarter, but it is supposed to be enhancing human capability. Mr. Mukesh Ambani announced a massive 10 lakh crore rupee investment over the next 7 years to power India's AI infrastructure. Sam Altman of OpenAI warned that the coming years will test global society. And of course, we also had French President Emmanuel Macron, who was all praises for India's digital identity model. And Mr. Sundar Pichai of Google unveiling plans for a full stack AI hub, which is going to be backed by a big $15 billion investment. Here are some of the key moments from yesterday's action. Thank you so much for watching. More coming up on Moneycontrol.
इतिहास में हर कुछ शताब्दियों के बाद एक टर्निंग पॉइंट आता है और वो टर्निंग पॉइंट सभ्यता की दिशा रीसेट करता है और वहीं से विकास की रफ्तार बदलती है। साथियों, आर्टिफिशियल इंटेलिजेंस मानव इतिहास का ऐसा ही ट्रांसफॉर्मेशन है। आज जो हम देख रहे हैं, जो प्रिडिक्ट कर रहे हैं, वो इसके इंपैक्ट का सिर्फ प्रारंभिक संकेत है। एआई मशीनों को इंटेलिजेंट बना रही है, लेकिन उससे भी अधिक मानव सामर्थ्य को कई गुना बढ़ा रही है।
In all humility, I wish to state that Jio, with over 500 million loyal subscribers, was privileged to play a leading role in this transformation across broadband, 4G, 5G, and home connectivity. With equal humility, I would like to announce that Jio will play an even bigger role in India's AI transformation. Today, on behalf of the Reliance Group and Jio Intelligence, I want to make 3 announcements. Announcement 1. Jio connected India to the internet era. Jio will now connect India to the intelligence era. We will deliver intelligence to every citizen, every sector of the economy, and every facet of social development and every service of government. Jio will do so with the same reliability, quality, scale, and extreme affordability that transformed connectivity. India cannot afford to rent intelligence. Therefore, we will reduce the cost of intelligence as dramatically as we did the cost of data. Announcement 2. Jio, together with Reliance, will invest 10 lakh crores over the next 7 years, starting this year.
For a democratic AI future, it is not enough to just give people tools and wealth. We also need to give them agency and power. The vision that AI companies lay out fundamentally reduced to either unilateral control or decentralized power. Sharing control means accepting that some things are going to go wrong in exchange for not having one thing go mega wrong. Cemented totalitarian control. This is a fundamental trade-off of democracy, and it is one that we believe in very strongly as the way to give everyone collective agency over the future. Of course, this is not to suggest that we won't need any regulation or safeguards. We obviously do urgently, like we have for other powerful technologies. In particular, we expect the world may need something like the IAEA for international coordination of AI, and especially for it to have the ability to rapidly respond to changing circumstances. The next few years will test global society as this technology continues to improve at a rapid pace. We can choose to either empower people or concentrate power.
And India built something that no other country in the world has built, a digital identity for 1.4 billion people. A payment system that now processes 20 billion transactions every month. A health infrastructure that has issued 500 million digital health IDs. Here are the results. They call it the India Stack, open, interoperable, sovereign. That, dear friends, is what this summit is about.
It's wonderful to be back in India. Every time I visit, I'm struck by the pace of change, and today is no different. Back when I was a student, I often took the Coromandel Express train from Chennai up to IIT Kharagpur. To get there, we passed through Visakhapatnam, Vizag. I remember it being a quiet and modest coastal city, brimming with potential. Now in that same city, Google is establishing a full-stack AI hub, part of our $15 billion infrastructure investment in India.